Hello, happy Tuesday, everybody. Gina here with your September 30th weekly market update. Today, the last day of September, officially marks the end of Q3, believe it or not. So the US market is ending Q3 near record highs with pretty strong bullish tendencies and momentum. The S&P has now rallied roughly 38% from its April lows. Interesting time though, because the stock market sentiment is really not matching up, aligning or jiving with sentiment around the economy. Most of that, I believe, is due to a lot of uncertainty still revolving around the economy. Inflation remains still elevated, along with this quarter we had a weak jobs report. There's uncertainty around tariffs and how that's all going to still shake out and influence the economy, rising policy risks and geopolitical risks, and obviously the concern of a potential federal government shutdown. So going to time out and pause there real quick to take a moment and discuss the potential reaction that we could see in the markets from a government shutdown. At least what has happened historically and what we would potentially expect for this go around. So what can influence and what we look at or would be concerned with as far as the market's concerned with a shutdown is really multifaceted. So the government employee furloughs would mean less spending, so less money circulating through the economy. There obviously could be delayed economic data, so those key reports would not be available. We wouldn't have full transparency to make decisions. There would be corporate exposure to government spending if they heavily relied on government contracts, et cetera. And then regulation gaps as well. So if the federal employees are working on a skeleton crew, there would be less individuals for regulation. The interesting fact, the longest government shutdown that we have ever experienced was 35 days. That was back in December of 2018 into January of 2019. And really, since then, that shutdown has showed minimal long-term impact on overall markets. If this were to happen, we would certainly expect a brief uptick in volatility. There would be possible modest sell-offs, but historically, this has been minor and short-lived. And actually, treasuries can rally as investors seek safety outside of equities. But again, in the past, the US government shutdowns have been treated by the financial markets as minor and short term rather than a long-term systemic threat. But in conclusion, Q3 saw a very resilient market recovery following some pretty early year shocks. We experienced strong gains that was then supported by federal rate cuts, eased tariffs, and economic expansion. So markets seem to be navigating the inflation pressures well and demonstrating to us that it's fairly resilient. Of course, moving forward, the risks for rest of year remain and likely will be around policy and geopolitical uncertainty, which we will continue to monitor. As always, if you have any further questions or concerns, don't hesitate to reach out.